Let's stick with the markets. The Wall Street Journal dubbed our next guest its most accurate economic forecaster for 2023. And guess what? She remains bullish for 2024. Belinda Roman, St. Mary's University Associate Professor, joins us now. Thank you for joining us. Congratulations on the distinction. I guess first, what did you see that none of the other mainstream economists, including the Fed, seemed to forecast for last year?
Thank you very much for inviting me. I think what I did was I looked at the volatility. There was a significant amount of volatility, especially in the labor markets, and I felt like we weren't swinging widely enough, or maybe taking into consideration what that was trying to say to us. So I tried to capture it in my what I did as a forecast.
Got it. So what are you expecting for this year, given the labor market still looks good?
Yes, I think we're still very robust. We're going to do well. I just think that we also have to remember that we're slowing down. And it's that slowing down that causes a lot of consternation, let's say. There are certain parts of the economy that are going to maybe feel it a little bit more than others in terms of slowing, but the aggregate is going to be positive. And I think depending on our political situation, again, that may change. It may become better, it may become worse, but I'm relatively optimistic.
Do you see politics as a swing factor for growth this year? How does that work?
Yeah,
I feel like the market's largely ignoring it at this point.
Yeah, I don't think you can discount politics at all levels, because this is an election where we have politics at the local, the state, and the federal level, and lots of moving parts. So as those parts are settled, then individuals start making policy and we start seeing changes, or the perception of change. And that filters down from the bottom up, and filters all the way through the economy. I think we need to think about that a little bit.
Belinda, a lot of questions today about what's happening in China, the deflationary CPI numbers on the front of the FT today, some chatter about property managers actually all around the world selling properties in Toronto, and forcing some warnings at the ECB in Europe that the property crisis in China is making its way across the globe. How much do you think about that?
No, I do, because I think, we're increasingly globalized. So there are some markets in the United States that have very intimate ties with the foreign sector. So as those start shifting, ours also start shifting. I think of the East Coast, the West Coast, and even in Texas and Houston, places like that, Dallas. As they start to shift, we start to shift. Those markets are tightening as well in all the domestic areas because of the interest rates. So we've got to think about those things as they're moving pieces.
Yeah, the question, I think, for this year, and something that's being debated on the Fed and also on Wall Street, Belinda, is whether the economy is so strong that we don't need the Fed cuts immediately, or maybe the number that the market has been expecting this year. What's your sense of how interest rates are restraining the economy, and what the appropriate level should be by the end of this year?
Well, I mean, I'm thinking that the interest rates do play a part, especially when we're looking at big ticket items. We've seen it in the housing sector, we're seeing it in the automobiles and anything else that requires a big chunk of money and also is dependent on the interest rate. So I think the Fed is looking at some of these things and thinking, okay, how can we kind of moderate the impact of higher interest rates as well as bring it down? But the timing is going to be difficult because there's these things going on. The China, the ECB, the Europeans are having trouble. So how does that filter over to us? And then how do we incorporate it into our models?